All right, stop scrolling for a second, because something just snapped in the silver market and it didn't happen quietly. Last week, silver got slammed from about $121 down to $72 in a matter of days. That's nearly $50 erased. Fast. And while everyone was staring at charts and arguing about leverage, this morning, the U.S. is hosting a 50-nation critical minerals ministerial, and at the same time, there's a live push for a $12 billion strategic minerals stockpile modeled after the Strategic Petroleum Reserve. Governments are buying. Paper markets are panicking. Both sides just confirmed their hand, and that clash matters right now. If you're holding silver, if you're watching it, if you're trying to figure out what's real and what's noise, your job is to understand what's actually driving this move. Stick with me, because I'm going to show you what's happening under the surface and how you can spot it next time before the crowd does. Before I explain what caused that violent drop and the rebound that followed, let me teach you something most people never really internalize about commodities. You don't just have a price. You have two worlds living on top of each other. One is the paper world. Futures, options, leverage, margins, all moving at digital speed. The other is the physical world. Mines, refineries, manufacturers, governments, moving at human speed. Think of it like airline tickets versus airplanes. You can trade tickets all day long, back and forth, price moving up and down. But if there aren't enough planes, reality eventually shows up. Silver lives in that gap. It trades like a financial asset, but it behaves like an industrial input. And when those two worlds fall out of sync, you get volatility first and repricing later. That's the setup you're watching for right now, whether you realize it or not. When traders look at commodities, they look for the spread between paper and physical. They look for premiums. They look for delivery stress. Think of it like this. Imagine you're buying concert tickets. The face value is one thing. That's your futures price. But if the show's sold out and you need tickets tomorrow, you're paying whatever the scalper asks. That's your premium. That premium tells you about availability, not just demand. It tells you about stress in the system. So what does that tell us? When paper prices collapse but physical premiums stay elevated or even widen, you're watching two different markets price two different realities. One's pricing fear and forced selling. The other's pricing scarcity and access. And right now, that's exactly what's happening in silver. If this is making sense, drop a comment below and let me know where you're watching from. I want to know if you're seeing this play out in your market too, because this isn't just a US story, it's global. Now here's what's actually happening under the hood. Let me break down the sequence because the mechanics matter more than the headlines. The primary driver was margin pressure. As silver pushed higher over the past few weeks, leverage built up in futures. And I mean, it really built up. When you're trading on margin, you're borrowing to amplify your position. That works great on the way up. But when selling hits, whether you want to call it engineered or mechanical, margins spike and forced liquidations kick in. And that's how you get a waterfall move from $121 down to $72. It's not mysterious. It's not magic. It's math. When prices fall, your account equity falls faster. If you're leveraged, your broker makes a margin call. You either post more cash or your position gets closed automatically. And when enough positions get closed at the same time, you get a cascade. That's what happened here. No debate there. But here's the secondary confirmation most people missed, and this is where it gets interesting. While that paper selling was happening, physical premiums didn't collapse. In fact, in Asia, Shanghai kept pricing silver $14 to $15 above Western quotes. Let me say that again. While New York and London were pricing silver in the 70s, Shanghai was pricing it in the mid to upper 80s. That's not speculation. That's availability stress. That's people paying more for metal they can actually touch and move and use. So when the paper price hit the lows, real buyers stepped in, quietly locking supply. That's why you've already seen a rebound back toward 90, roughly a 20% move off the lows in just a few days. The paper market flushed, the physical market absorbed, and now you're watching the gap close. But here's the part that should make you nervous if you're only watching futures charts. Governments don't care about your daily candle. When nations start planning stockpiles, they're signaling that access matters more than price. And that's not just talk. This isn't a press release that gets forgotten next week. The US is literally hosting a 50-nation ministerial on critical minerals right now. At the same time, there's active legislative movement on a $12 billion strategic minerals stockpile. That's modeled after the Strategic Petroleum Reserve, which means it's designed to secure supply for national security and industrial needs. When governments move into a market, they don't trade. They accumulate. They don't care if they're buying at 90 or 100 or 110. They care about securing tonnage. And silver isn't just a shiny metal. It's in solar panels, electronics, defense systems, batteries. It's a strategic input. Now let me show you what very few people are talking about. When you line up the forced selling in paper markets with sovereign and industrial buying in the physical market, You get a pressure cooker. Here's why. Forced selling is temporary. It's mechanical. It exhausts itself when leverage gets flushed out and margin calls stop. But sovereign buying, that's persistent. It doesn't stop because the price moved 5%. So when margin selling exhausts itself, there's suddenly less metal available at exactly the moment demand is getting less price sensitive. You've got nations saying we need X tons per year for the next decade, and we're not waiting for a pullback. And you've got industrial users who can't afford to run out of supply because their production lines depend on it. That's the convergence. That's why this isn't just a bounce. It's a structural tension building in real time. And if that tension keeps building, the paper market eventually has to reprice to where the physical market already is. This is the exact same playbook we've seen before. And I want to show you the pattern because it matters. Zoom out and you see it clearly. In 2011, silver whipped violently as leverage washed out. It ran up to nearly $50, then crashed back down as exchanges raised margin requirements and forced liquidations rippled through the market. Sound familiar? But then, once the leverage was gone, physical demand overwhelmed paper supply and silver surged again. Same setup, different year. You had paper selling creating volatility, physical buying creating a floor, and repricing once the dust settled. In March of 2020, during the global liquidity panic, we saw it again. Paper prices collapsed. Silver futures dropped to the mid-teens while dealers were charging $25, $30 an ounce for physical metal. People couldn't get coins. Premiums exploded to $8, $10, $12 over spot. Why? Because when fear hits, everyone sells paper and buys physical. And what followed? A sharp upside repricing once the system stabilized. Silver went from the mid-teens to nearly $30 in a matter of months. Every time this setup appears, the sequence is the same. Volatility comes first, confidence breaks second, and repricing follows once reality reasserts itself. Now, before we go further, let me give you the larger story here. Markets don't reprice because of headlines. They reprice when availability and demand collide after leverage has already been flushed. That's the key. The flush is necessary. It clears out weak hands. It resets sentiment. It creates the conditions for a structural move. And right now you're watching that flush happen in real time. The question isn't whether it happened. The question is whether physical demand is strong enough to create the next leg up. And based on what I'm seeing in premiums, based on what governments are signaling, based on industrial demand trends, I think the answer is yes. But let me be clear. I don't know. None of us know. We're interpreting signals. We're reading data. We're making informed judgments. And that's why you need to understand the mechanics yourself, not just trust someone else's conclusion. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. Paper markets can stay dominant longer than anyone expects. Futures can keep setting the reference price if liquidity stays deep and confidence holds. And not every government announcement translates into immediate buying. I've seen plenty of initiatives get announced and then delayed or watered down or quietly shelved. So could this stockpile plan fizzle out? Sure. Could industrial demand weaken if we hit a recession? Yes. Could premiums in Asia narrow if supply loosens up? Absolutely. Could this whole thing be manipulated? Maybe. People love to talk about manipulation in silver. And look, I'm not going to sit here and tell you markets are perfectly efficient and nothing shady ever happens. But here's the thing about manipulation claims. They're only useful if you can identify the mechanism. If you can't point to how it's happening, who's doing it, and what specific trades or positions are creating the effect, then you're just shouting into the wind. So instead of arguing motives, focus on what you can actually measure. Premiums, inventory flows, price reactions after forced selling. That's where the signal lives, not in theories. If premiums are elevated, that's measurable. If Shanghai's pricing $14 above London, that's a fact. If silver rebounds 20% off the lows in 72 hours, that's data. Work with what you can verify, and let the conspiracy debates happen somewhere else. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation is different. Maybe you're the short-term trader. You live on levels and momentum, and you're asking, does 90 hold or not? For you, the key is discipline. You're not trying to predict the future. You're trying to react to what the market shows you. So here's what I'd be watching if I were in your shoes. Watch that 88 to 90 zone midweek. If it holds, if you see buying come in and support that level, it tells you selling pressure is exhausted. It tells you the flush is done. That's your signal to consider re-entry if your strategy supports it. But if it doesn't hold, if you see 88 break and momentum roll over, step back. Don't fight it. There's no metal for catching a falling knife. Let it find a floor, let it show you a reversal, and then engage. Your edge as a trader is knowing when to act and when to wait. And right now, waiting for confirmation is probably the smarter play. Maybe you're the longer-term investor. You don't care about daily noise, but you care about regime shifts. You care about whether the fundamental story is intact or broken. For you, this is about understanding that silver is being treated as a strategic input, not just a shiny trade. And that changes everything. It changes how you size risk. It changes how you time entries. It changes your holding period. If governments are building stockpiles, if industrial demand is structural and not cyclical, if supply is constrained because mining is capital intensive and slow to respond, then you're not trading a commodity. You're positioning in an asset that's transitioning from abundant to strategic. And that's a different investment thesis. So what should you do? Honestly, I think you're looking for entries on weakness, not strength. If you believe the structural story, you want to buy when paper markets panic and physical markets stay firm. You want to add when premiums are wide and fear is high, because that's when the gap between perception and reality is widest, and that gap is where returns come from. Or maybe you're new. Maybe you're just trying to learn how markets work, how to read signals, how to think critically about what you're seeing. If that's you, focus on the lesson here. When paper prices diverge from physical reality, volatility is a feature, not a bug. It's not a mistake. It's not broken. It's the market trying to reconcile two different pricing mechanisms. And if you can learn to read that divergence, if you can learn to watch premiums and inventory and demand signals instead of just price charts, you'll have a skill set that applies no matter the asset. Because this same dynamic plays out in oil, in copper, in grains, in anything that trades as both a financial instrument and a physical commodity. The principle is universal. So here's what I want you to answer in the comments. What are you watching in your market? Are you seeing premiums widen? Are you seeing physical availability tighten? Are you seeing anything that confirms or contradicts what I'm laying out here? Because I don't have all the answers. I'm showing you how I'm interpreting the data, but markets are global and signals show up in different places at different times. So share what you're seeing. Let's make this useful for everyone. Here's where I stand. I'm not chasing, I'm not panicking, I'm watching. Let me tell you what I'm personally watching, because this is how I'm thinking through the next few days and weeks. First, I'm watching whether that 88 to 90 area holds into midweek. If it does, if we see consolidation or even a grind higher, that tells me the forced selling is done and we're transitioning to a different phase. If it doesn't, if we break lower, then I'm watching for capitulation volume, because that would mark the final flush before a reversal. Second, I'm watching the 95 to 100 zone into Friday, because that's where breakouts get tested. If silver can reclaim 100 and hold it, that's a major psychological level, and it would suggest the rebound has legs. If it stalls out in the mid-90s, then we're probably in for more consolidation. Third, I'm watching premiums. If Shanghai stays $14 to $15 above Western pricing, that pressure doesn't just disappear. That tells me physical demand is real and persistent. And if that premium starts to widen even more, that's a red flag that supply is getting tighter, not looser. Based on my analysis, this move down was mechanical, not emotional. It was driven by margin calls and forced liquidations, not by a fundamental breakdown in the silver story. The fundamental picture has actually gotten stronger, not weaker. You've got governments signaling strategic intent. You've got industrial demand that's structural and growing, especially in solar and electronics. You've got mining supply that's constrained because silver is mostly a byproduct of other metals, so it doesn't respond quickly to price signals. And you've got a paper market that just flushed out a ton of weak hands and over-leveraged positions. All of that sets up a spring. It doesn't guarantee a move, but it creates the conditions for one. If history rhymes, and if silver can hold these levels and build a base, the move that follows could be fast and significant. I'm not saying it goes to 150 or 200. I'm not making a price target. I'm saying the setup looks similar to past cycles where volatility led to capitulation. Capitulation led to a floor, and the floor led to a sharp repricing once the market realized the fundamental demand hadn't gone anywhere. That's the pattern. That's what I'm watching for. I'm not a financial advisor. This is not financial advice. I'm sharing how I'm analyzing the market and what I'm watching. But you need to do your own research. You need to verify the data yourself. You need to make decisions based on your own risk tolerance, your own timeline, your own goals. Don't take my word for anything. Go look at the premiums yourself. Go check the Shanghai prices. Go read the legislation on the strategic stockpile. Go verify it. Because the only way you'll develop conviction in your own analysis is if you do the work yourself. If you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well, not just in silver, but in every market you touch. Because markets reward people who can separate signal from noise, who can read between the lines, who can see structural shifts before they become obvious. And that's a skill you build over time by studying patterns, by watching how markets behave under stress, by learning to interpret data instead of emotions. If this helped you see the situation more clearly, share it with someone who's trying to figure out what's going on. Subscribe if you want more breakdowns like this. And stay sharp, because this market is moving fast, and the people who understand the mechanics are going to be the ones positioned ahead of the crowd. I'll see you in the next one. Stay sharp out there.